A recent survey found that 73% of investors can't explain the difference between index funds and ETFs, and this confusion is costing them thousands. One investor I know chose the wrong one and lost $50,000 in potential gains over just 10 years. Today, I'm going to make sure that never happens to you. Welcome back to Cashflow Kingdom, where we break down personal finance without the jargon. I'm your host, and if you're tired of being confused about investing basics, you're in the right place. In the next 11 minutes, you're going to understand exactly what index funds and ETFs are, how they're different, which one might be better for you, and most importantly, how to avoid that costly mistake. Let's start with index funds, because they're probably what your parents invested in. An index fund is like buying a slice of the entire stock market pie. Instead of picking individual stocks like Apple or Tesla, you're buying into a fund that owns hundreds or thousands of companies. Think of it like a basket that holds pieces of all the biggest companies in America. The most popular one tracks the S&P 500, which includes companies like Microsoft, Amazon, and Google. When you put money into an index fund, you're essentially saying, I want to own a tiny piece of all these successful companies. The fund manager takes your money, pools it with thousands of other investors, and buys all those stocks for you. It's like having a professional shopper who buys groceries for your entire neighborhood. The beauty is that you don't need to research individual companies or try to time the market. Now let's talk about ETFs, or exchange-traded funds. Here's where it gets interesting. ETFs are like index funds' younger, more flexible sibling. They do the same job of holding a basket of stocks, but they work differently behind the scenes. The biggest difference? ETFs trade on the stock exchange just like individual stocks. That means you can buy and sell them anytime the market is open, not just at the end of the day like index funds. It's like the difference between shopping at a traditional store that is set hours versus an online store that's open 24/7. ETFs also tend to have lower expense ratios, that's the fee you pay the fund company. Where an index fund might charge 0.2%, an ETF tracking the same index might only charge 0.03%. That difference might seem tiny, but over decades of investing, it adds up to serious money. Plus, ETFs offer more variety. You can find ETFs for specific sectors, countries, or investment strategies that traditional index funds might not cover. Let's cut through the noise and focus on what actually impacts your money. First, minimum investments. Most index funds require anywhere from $1,000 to $3,000 to get started. ETFs? You can buy a single share for as little as $50. That's a game changer for beginners. Second, trading flexibility. With index funds, if you decide to sell at 2 p.m., your trade happens after markets close at 4 p.m. at whatever price the fund closes at. With ETFs, you can sell immediately at the current market price. Third, automatic investing. This is huge for building wealth. Most brokerages let you automatically invest a set amount monthly into index funds, even buying fractional shares. ETF automatic investing is less common, though it's improving. Fourth, tax efficiency. ETFs generally create fewer taxable events due to their structure. For taxable accounts, this can save you hundreds or thousands in taxes over time. However, if you're investing in a 401k or IRA, this advantage disappears since those accounts are already tax-advantaged. If this comparison is helping you understand investing better, hit that like button and subscribe for new money tips every Tuesday. Here's the story behind that $50,000 mistake. My friend Mike started investing in 2013 with $500 monthly. He chose a popular S&P 500 index fund with a 0.65% expense ratio because it was what his bank offered. Meanwhile, his coworker Sarah chose an S&P 500 ETF with a 0.03% expense ratio through a different broker. Both invested the same amount, in essentially the same companies, for 10 years. The difference in fees alone cost Mike over $8,000. But here's the kicker, Mike's index fund had a sales load, a 1% upfront fee he didn't understand. That cost him another $3,600 over the decade. Plus, Mike's fund wasn't as tax efficient, costing him roughly $2,400 more in taxes. But the real killer was opportunity cost. Because Mike's minimum investment was so high, he couldn't invest his tax refunds and bonuses as easily. Sarah could buy fractional ETF shares with any amount. When we calculated the compound growth of those missed opportunities, the total difference was over $50,000. Same market returns, different vehicles, massive difference in outcomes. So which should you pick? It depends on your situation. Choose index funds if you want simplicity and automation above all else. If you're investing through your employer's 401k, you'll likely only have index fund options anyway. Index funds are also great if you want to set up automatic monthly investments and never think about it again. The higher fees are worth it for some people who value the hands-off approach. Choose ETFs if you want lower costs and more flexibility. If you're starting with less than $1,000, ETFs remove that barrier to entry. If you're investing in a taxable account, the tax efficiency can save you real money. ETFs also give you more options. There are ETFs for almost every investment strategy you can imagine. Here's my personal take, and remember, this isn't financial advice. For most beginners, I lean toward ETFs. The lower costs compound over time, and the flexibility helps you invest more consistently. But honestly, the most important thing is that you start investing, period. Whether you choose an index fund or ETF matters way less than actually beginning your investing journey. Let's make this actionable. First, choose a reputable broker. For ETFs, I recommend platforms like Fidelity, Schwab, or Vanguard. They offer commission-free ETF trading. If you prefer index funds, these same companies offer excellent low-cost options. Second, decide on your index. The S&P 500 is a solid starting point. It's basically the 500 largest US companies. Third, start small but start now. Even $50 monthly beats waiting until you have thousands saved up. Time in the market beats timing the market every single time. Fourth, automate everything you can. Set up automatic transfers from your checking account to your investment account. The less you have to think about it, the more likely you are to stick with it. Finally, ignore the noise. You don't need to check your investments daily or chase the hottest new fund. Boring, consistent investing wins the long game. Pick one fund, invest regularly, and let compound interest work its magic over the next 20 to 30 years. So there you have it, the real difference between index funds and ETFs, and how understanding this distinction can save you thousands. The key takeaway? Both are excellent ways to build wealth, but ETFs generally offer more flexibility and lower costs for most investors. Don't let analysis paralysis stop you from starting. Pick one, start investing consistently, and adjust as you learn more. Remember, this isn't financial advice, I'm just sharing what I've learned and observed. Always do your own research and consider your personal situation. What questions do you still have about index funds or ETFs? Drop them in the comments below. And if you want to dive deeper into investing basics, check out the video I'll link in the end screen about building your first investment portfolio. Thanks for watching, and I'll see you next Tuesday with another money topic that matters.